Hi, this is Matt Collis. I'm the CFO of Parasoft, and you are listening to CFO Thought Leader.
This is episode 1101.
So my focus really is ensuring that, look, we can navigate this, pretty uncertain capital environment over the course of the next 12 months and ensure that we've got enough capital to run the business the way we want to. Try to streamline and move towards standardization on a lot of these things. So we're at Hometap's at an inflection point where we've transitioned out of what I would call the very early stage, and we're now in a growth stage. And in order to do that and do that effectively, we have to start to, herd the cats, for lack of a better term, and move to more standardized terms and more standardized scalable processes. Frankly, part of that is also brand marketing and thinking through, like, how do we start to separate the brand from the product to ensure that when people think of Hometap, they think of a great HEI experience, but they also think of Hometap is going to help me figure out my home ownership challenges as opposed to just like one very specific niche product.
Hello, everyone. Today's guest, Hometap CFO Tom Egan, has spent his career translating complex capital markets know-how into consumer-friendly finance. After 15 years structuring high-yield deals on Wall Street and in London, Egan now steers the Boston-based pioneer that lets homeowners unlock equity without new debt. But as he reminds us, Hometap's home equity investment is only an opening act. In this episode, we explore how Egan and the management team is turning that single offering into a flexible platform, one designed to ease the financial strain of ownership across every stage of the homeowner's journey. You'll hear about that and much more on today's episode. Our talk with CFO Tom Egan begins after this.
When it comes to company spend, most finance teams are on defense, reacting to surprise spend, chasing receipts, saying no. But there's a better way. Meet Brex, the AI-powered spend platform that boosts a company's control, earnings, and speed. 99% of customer spend is compliant. 11 million hours saved on expenses and accounting through automation. $681 million plus dollars back to customers in business building rewards. Make every dollar count with Brex.
Hello, we're joined by Tom Egan, who stepped into the CFO seat at Hometap last fall. Backed by 15 years in investment banking and prop tech finance, he's now steering the home equity investment pioneer's next phase of growth. Tom, welcome.
Thanks, Jack. Great to be here.
Tom, it's been something of a windy road. At least the first part of your career path certainly was. Can you tell us something about it? Go back in time and try to identify those experiences for us that you believe helped prepare you to become a CFO. What comes to mind?
Yeah, sure. Happy to. So yeah, my background is a little bit different. So I started out as a lawyer. I practiced in corporate finance and M&A for about 5 years here in the Bay Area. And I sort of got to a point where I decided that the folks that I was working with, the investment bankers, private equity investors, venture capital investors, just seemed like what they were doing was more interesting than what I was doing, and decided to make a switch. My goal initially was to get into a private equity seat, but I was told by folks in the space that I needed to spend time in an investment bank in order to learn how to do that, and then I could potentially transition later to a private equity role. I moved into investment banking really with the goal of getting out of investment banking. It was only ever supposed to be a means to an end. Found myself in New York in the sort of mid 2000s. There was a huge leveraged buyout boom going on, and I joined a leveraged finance team at Merrill Lynch and subsequently at Lehman Brothers. And you can probably see where this is going. In 2008, I was at Lehman Brothers, financial crisis hit. And it just, at that point, I had been in banking for 3 and change years, and it felt like setting aside the financial crisis would have been the right time. It was like kind of 2-3 years in, and then I could have made a switch. But unfortunately, given the crisis, did not make sense at that point in time to sort of pull up stakes and try to switch careers in the middle of a generational financial crisis. I kept my head down, I kept my job, kept my health insurance. A very close colleague of mine that I had worked with at Lehman had moved over after Barclays acquired us, had moved over to London. And he called me at one point and said, hey, could really use your help over here. We're building out a new business. I moved over there in 2011. And it really sent me, the really interesting thing about that was it was a really interesting opportunity to build a business and really restart a business inside of a very large, Barclays is a 400-year-old British banking institution, but we were essentially creating a new business inside of it, which was the high yield business in Europe, which didn't really exist in the same format in the US pre-crisis. And so the intent was to bring over a bunch of us from the US that had this experience and could actually import that technology and that sort of mindset to the European market, which was going through a pretty fundamental shift post crisis. So it gave me this really interesting lens into sort of operating in a very small team and doing something that was very entrepreneurial, but with the backing of a gigantic institution. So we knew we weren't going to fail, or the lights were going to stay on, but it was a sort of whet my appetite into getting into something a little bit more entrepreneurial and smaller scale. Post Brexit, the European markets were in a little bit of uncertainty. My visa was up in the air. It was unclear as to whether or not my job was going to continue to stay in London, and it might have moved to Frankfurt or Paris or Dublin or one of the sort of EU cities. And my kids were at an age where it made sense for us to think about moving back to the States before they sort of got into middle school and high school. And again, I woke up and I was like, you know what? I didn't want to be an investment banker at all, let alone for a dozen plus years. And so made the decision at that point to pursue a sort of a prop tech, actually fintech was where I thought I would end up, given sort of the background I had in financial markets, and the sort of the entrepreneurial sort of things that were happening in fintech. And so came back to the Bay Area with the intent of getting into a fintech seat. Moved back here in 2017, 2018, I joined an SFR, a single family rental property startup that was building out a rent to own platform. And I did that. I joined as the sort of head of capital markets to raise some money there, and then ended up moving into the CFO seat, spent about 5 years there. And then subsequently spent a little bit of time just figuring things out, and then came back into the fray in the fall of last year at Hometap. So I guess in terms of like how the background set me up, I think it's a really interesting question. I think as I was going through it, I didn't really think about the setting myself up as a CFO. And in fact, probably never would have, if you had asked me at any point along the journey, I don't think I ever would have said that I was setting myself up for a CFO role. And in fact, really, I moved into the fintech, prop tech world really with a focus on capital markets. And I don't think I would be a CFO. To be perfectly frank, like I don't think I could be a CFO of any business that didn't have a capital component to it, or I certainly wouldn't be the most obvious candidate. My background is really in capital markets, and that's where I tend to add value. I'm not an accountant, nor do I pretend to be. And I know enough about FP&A and budgeting and strategic finance and corporate development to be impactful there. But really, the value add is around cap markets. And so the businesses that sort of came about that were straddling between a sort of consumer-facing technology solution, but with a financial product in the background, is really where my niche that's where my niche is, and that's where like I said, I can add value. My background in cap markets, my background in debt structuring and investor-facing conversations, and creating the narrative and going out and raising capital against it is really where I like to spend time and where I think I add the most value. So that's really how I found myself in this role. My prior role, and similar at Hometap, but much more so in my prior role, the finance function really started as a capital markets function, and then it was like, oh well, we this is all sort of finance related, so we can build into it. But my background, again, my starting point was cap markets, and then we built the finance function around that. Hometap is a different animal. I came into it at a much later stage, but the capital component is fundamental to the business. And so again, I wouldn't be the right candidate for this role if it was a SaaS business, for example. It's just not.
So we're wondering what some of the lessons were that perhaps you've brought forward. And you mentioned EMEA. What lessons from structuring high yield transactions in EMEA might still guide your thinking when you design Hometap's capital stack?
Question. I think so high yield, because it is, it's a dicier part of the credit spectrum. So you're dealing with companies and investors that are, well, companies in particular they're smaller, they're more cyclical, they're taking on more leverage. They're oftentimes owned by financial sponsors. So you're dealing with pretty sophisticated counterparties, and the credit investors are as well, because they have to be, because you're dealing with riskier investments. And so I think that lens of coming at it from the perspective of it's a new, like, prop tech and fintech they're newer. You're dealing with, an investor getting comfortable, not just with the credit product that you're offering or the credit risk that you're embodying, but also the fact that you've got a brand new company and a brand new product. And so that element of sort of creativity, but also storytelling, narrative, understanding what the customer on the other side is looking for. And really, it's a matchmaking. There's a commercial sort of sales component to it, but fundamentally at the end of the day, like, you're sort of, it's a heavily structured, it's a heavy structuring role, in the sense that you have to spend a lot of time really thinking through all of the downside, but also how to solve the investor's questions, because you're not starting off with a product that's well established and is product, both financial product but also credit product, where these are bonds that have been issued for hundreds of years, and they're the same, and it's the same company, and it's single A risk, and you're never going to lose money here. It's just a question of what the price is. You're really not. That's not really where you're starting. Your starting point is like, hey, we've got this cool thing. We think it really works well. It solves a lot of problems for our homeowner customer, but the only way we can offer it is if we've got credit. Like, we need a lot of capital. So the way that we have to find the right balance between offering a product that the consumer wants, but also creating something that works for the credit investor on the backside. And it's that element of sort of, figuring things out, but also not being constrained by, the structures that have been established in the past. But you also have to be really thoughtful, because when you put something like this in place, you put a credit investment in place, it's a 3 to 5 to 7 year relationship that you're establishing with this investor. And so, especially in the context of a very, rapidly growing and developing business, it can be really challenging sometimes to find that balance between, optimizing for what we have today versus optimizing for where we're trying to get to. And so that is not something that I really dealt with necessarily in high yield, because high yield tends to be more mature businesses. Those that, like, the businesses that are accessing that market they're cyclical, they're smaller, riskier, but they're also more established, and you've got cash flow, and it's easier to predict. But again, the nice thing about the high yield background is it's very document intensive. It's a credit intensive business, but it's also a very document intensive business. And so you get very comfortable. I was just a former lawyer, which is why a lot of former lawyers end up in high yield, is because it does tend to prioritize or value that document knowledge. And so having that background and being very familiar with and facile with the documents, that really served me extremely well when I stepped into a operating role, because so much of the complexity of these documents and these facilities is really getting the operations right. It's not just about the price and the term and the leverage, which are important, but they tend to be more range bound and standardized. The challenge and what makes it interesting and what makes a good facility versus a bad one is it's very often in the nitty gritty of the operational complexity of the document, which again, not something I spent a lot of time with as a high yield banker, but something, at least being familiar with the documents and being able to step into it is something that was extremely valuable at the time.
Now, your first CFO chapter you opened at, is it Divvy Homes? How's it?
Yeah, Divvy Homes.
Divvy Homes. Yeah. And curious about them, from what I've learned about them, they have this rent to own model that was seen as rather innovative. I'm wondering if there are innovations from that experience. And again, that's a 5-year chapter, sort of a beefy CFO chapter, that you're intentionally bringing forward to Hometap. Are there innovations there that you've learned or lessons that you've learned in that CFO tour of duty?
Yeah, I think so. I would say specifically with respect to with the finance and capital lens, I think there's kind of two ways to answer that question. So through the finance and capital lens, I think the most important thing that I took away from that experience, because that was not only my first CFO role, it was also my first operating role. And so as you're thinking through how you set things up with capital facilities, I think the most important thing that I took away from there, which I touched on in the last answer, is like the dynamism of the business as it moves forward. And as you think through where the business is headed, it's very easy to get focused on solving the problem for today. And in reality, you've got to be really proactive about thinking down the road, like, where are we trying to get to? And then marrying up the, like, what can we do today? What's the art of the possible today? And then how do we set ourselves up for the future? And thinking about, like, how is our product going to evolve over time? How is our customer base going to evolve over time? What types of features and things are we trying to create? How will our product suite change? And how do we want to think about that? You can't necessarily solve all of those problems, but you can create some degree of flexibility in the document and in the credit facility and with the investor relationship to allow yourself to start to move in that direction. And the same goes really with respect to the finance org. I always tell my folks more broadly, when I hire people, I tell them you have 2 jobs. The first job is do the job that I hired you to do. The second job is watch yourself doing that job and figure out how to make it so that when the business doubles, we don't need to add another person and another person and another person. Or when we add a facility, we go from 1 facility to 3. We don't want heads to go from 1 to 3. We've got to figure out a way to scale this. So when you have a problem as a finance person and an accounting person or an FP&A or ops or whatever it is you're doing, think about, like, is this situation that's coming up, is this going to continue to scale with the business? So this one thing that happened, if it happens once every 6 months, it's probably not worth building a process around or hiring against. But if it happens once every 6 months, but then it's going to become once every 3 months, and then eventually once every 3 days and once every 3 hours, then we've got to figure out how to create a process that's scalable. And so your job is to do it, but then also identify those opportunities and create those, that pathway. So I always want people looking forward. The other lesson, which I said is probably broader than finance and capital, and my management style is more focused on, like, the consumer facing component of the business. And what's really the sort of the common factor between Divvy and Hometap is the real estate and property and prop tech, but also creating what I think of as a platform for the way that the business is successful in the long term is not to just be the best HEI, home equity investment provider, but also to the value and the differentiating factor for Hometap, which was similar for Divvy, was the relationship with the consumer and the relationship with the homeowner. And we are a consumer financial business. And so the way that we develop this business on a go-forward basis, and similar to Divvy, similar thesis I had at Divvy, is like, home equity investments need to be a product, not the product. We need to ensure that we're building other products and solving the customer's needs. We have this amazing opportunity to build a relationship with the consumer over, for us, up to a 10-year period. And if we do it right and we manage that relationship right and we do what we need to do to keep the consumer happy, there will be loads of opportunities for us to create additional value from that relationship. And so I think it's a mindset, but it's also like it really focuses you on ensuring that you're creating a customer experience that is durable. And by the way, Hometap had already been doing that, which is something that really attracted me to it in the first place, was that when I started having conversations, it was like, hey, this is the same mission, the same thesis, the same lens.
Yeah.
You were doing it.
So, Tom, we're going to want to ask you about Hometap, but before we leave the career journey portion, I think the common through line for your career, I think you emphasized, I think it's the capital, and you can correct me. I think it's the capital markets thread that you emphasized throughout our discussion. And but what I'm wondering is if there was a single career risk that you took perhaps along the way, maybe it was leaving law, don't know, that you feel, accelerated your readiness, let's say, to lead a fast-growing prop tech. If there was something along the way where you took a risk and it worked out for you, what might that have been?
I think, so it's a really interesting question. I would say, at the time, moving from New York to London, there was a different job that I took. So it was moving geographies, of course. It was moving positions within the bank. And it was moving into from a very well-established market and role into something that was far less certain. So at the time when I went over to Europe, the US high yield market was about $1 trillion in total notional dollar value. The European high yield market at the time was about 60 billion. So vastly different scale. I would have told you at that point, I think, having spent a couple of years in Europe, and I think I would have said, look, this sets me up really well for stepping into an entrepreneurial role. It's a very small team. We were starting from zero. We had to educate the market, educate the consumer, educate the customer, the companies, the issuing companies, educate the investors, spent a lot of time really doing a lot of early stage building of the product and the market, and also educating folks internally that hey, this is a product and here's how we're going to think about it. All that being said, when I actually made the switch and left the bank and went and thought, okay, I can do this, I know how to do this, that adjustment was extraordinarily difficult. And I would say I was nowhere near prepared for it. And it was the first year at Divvy was the hardest year I've had ever in my entire career. It wasn't the substance of what I was doing, negotiating credit agreements and telling the story. That was all the same. It's a different environment, of course, and you're talking about a different scale. So rather than doing a $2 billion deal, I was doing a $20 million deal, very different scale, very different focus. But fundamentally, a credit agreement is a credit agreement and a bond agreement is a bond agreement. It's all the same. That part was the same. And I understood that I was taking a degree of financial risk and I could quantify that. But I think what I would call existential risk, this sense of if I didn't do my job at the bank, I might get fired, I might not get a bonus, but the lights would stay on and things would continue. And eventually they would replace me and figure it out. And Barclays was going to go on, right? There was no risk to Barclays' existence by me not satisfying my obligations. But at Divvy, especially in the very early stage, it was a Series A. If I didn't do my job, if I didn't go out and raise capital, if I didn't execute on those deals, it was game over, not just for me, but for the whole company. And that degree of existential stress and risk, something that I didn't really even, it's not that I didn't quantify it or evaluate it appropriately. I just didn't even know it was there. And that was the element that was the biggest adjustment and the biggest challenge. I love it. I'm happy that I did it, but I don't know if I had known it was there, if I would have taken the leap. I don't know if I would have done it. If they were going to say this is, it's not just, you might not make any money here and the company you are going to be terrified on a daily basis that the company, that the company may fail and it's your fault. And that I think was something that I really hadn't appreciated. And so I think that, like I said, it's like doing it was actually the best preparation for it, because like I said, I couldn't have evaluated it beforehand, because it's like, yeah, I get it. I understand, but you really don't understand until you did it.
So let's find out now about Hometap. And I wrote down home equity investment lets owners tap equity with no monthly payments. How do you articulate the value proposition here? Tell us about it.
So I think it's probably important to just take a step back and think about what is our mission. So our mission and where we came from, where we started, is to try to make home ownership less stressful and more accessible. The starting point for that conversation and the flagship product is this home equity investment. And again, this goes back to what I said earlier about a product, not the product. Eventually, we want to build a suite of products that address that stress and accessibility component. But where we started was this home equity investment product. And you're exactly right. Essentially, what we do is we offer the homeowner the opportunity to access the liquidity in their home without having to sell or take on debt. And if you think back historically, you really only had two options. If you had a house that was worth $1 million and you had a $500,000 mortgage on it, you have $500,000 worth of equity in that home. Traditionally, the only way to access it was to take out a home equity loan, which is debt, and it's pretty expensive debt, generally speaking, which increases your monthly payment requirement and impacts your credit. Or you could sell the house and access all of it at once, but then you've got nowhere to live. So they work for some people, and sometimes if the timing works and it makes sense to sell and it makes sense, okay, fine. But it's not the perfect solution for everyone. And so the sort of the idea here, which was not my idea, but the idea that came about to Jeff and to others was, what if we offered this opportunity to access that liquidity, but do it in a form of equity so that you're not impacting your credit. In fact, you have the opportunity to improve your credit if you use it to pay down debt, and you're not increasing your monthly payments. And so if you're in a position where you're already tight on your monthly payments, but you need access to that liquidity, again, it can improve your monthly payments if you're paying down debt with it, but also it's not impacting your monthly payments at all. If you're like, look, I can pay what I pay today, but I couldn't pay more, but I still need to access that. And it's incredibly innovative. We've had enormous success with in the consumer market. It's a product that very clearly, there's customer demand for. We've done 19,000 of these over time, and we're not the only operator out there. There are others that are doing, it as well. And so the market has grown tremendously. We think there's an enormous amount of upside to it. And again, I think this is the beginning of this, what I would call a platform to address not just this particular problem, but really the entirety of homeownership.
I mentioned you joined last fall, really. And since then, I believe, and correct me if I'm wrong, I was looking at headlines, Hometap has passed the $1 billion mark in capital deployed. And I'm wondering how you prioritize for that first 100 days you're in the CFO role. What were some of the quick wins, perhaps, during that time as you surpassed that $1 billion mark?
Yeah. So the deployment. I would love to say that I had anything to do with getting over the milestone. That was a train that was running and at full speed long before I arrived. And so I was mostly just cheering from the sidelines to get over that threshold. My focus was much more immediate. When I joined in October, we were in the process of negotiating a couple of different partnerships with new capital that were coming online. And it was, in my mind, it was less about like, hey, we're going to hit this milestone and let's focus on doing that. That's all already taken care of. What I was focused on was like, well, what about the next 12 months and the next 12 months? And let's make sure that we've got enough capital, opco capital, as well as asset capital to continue to run the business. So we focused on that. There was like a focus on ensuring that we had sufficient liquidity to run the business. We went through an annual planning cycle to make sure we knew what we were, aligning on investments for 2025, and establishing sort of these two longer term partnerships that we could count on to put incremental capital to work. Because the issue for a business like ours, and frankly any business that is dependent upon capital, is you need visibility. When we are originating, when we start a conversation with a homeowner, it might be 45, 60, 90 days between when we initiate that conversation with the homeowner and when they actually close on an investment. And so we need visibility around our capital pipeline at least 3 months, and generally 6 to 12 months is preferable, so that we know, because in order to initiate the conversation with the homeowner, we have to have investment managers that we've hired and trained in order to actually, so it's like, then you got another 90 days. So we've got to back it up, so that we need to make sure that we've got a roadmap and a runway in front of us. Not OpCo runway in the traditional sense of like, okay, what's our burn rate and how much, how many people are we hiring, but capital runway, which is a multiple of that OpCo capital in a lot of ways, because we're talking about hundreds of millions of dollars. Right now we're deploying somewhere between $75 and $80 million per month. And so we need to know, we need to know 3 to 6 months in advance at least what the roadmap, what the pipeline looks like, so that we can continue to originate with confidence for our homeowner customers.
When it comes to scaling this company, scaling Hometap, and you think of the milestones that you look forward towards, is it geographic reach? Is it penetration, cost of capital, something else? What are those milestones? What exactly are they?
It's I think it's a combination of all of those things. I think geographic reach, you do get to a point, and we're not there yet. You do get to a point where it's diminishing returns, because there's a pretty heavy concentration within certain states and certain metros of the population of the U.S. So at a certain point, look, I'd love to be national, but at a certain point of growth, you can sort of, and we're not there yet, but we're getting close to the point where 25 or 30 states probably gets you 60 to 70% of the overall population of the U.S. And so I think it is a target, and we're working towards it. We're working towards, again, capital consistency and capital availability, and driving down the cost of capital. Yes, to the extent that we can do that, and it's always better. Cheaper is better for us and for our homeowner customers. But we think what we offer today is a pretty attractive cost of capital. But figuring out a dynamic way to do that and ensure that we're staying competitive with other products in the market and staying competitive in the investor's mindset is something that we'll probably look to improve upon over time. The penetration, to your point, I think that's probably the biggest upside opportunity for scaling this business. If you look at the sort of the overall home equity market, there's tens of trillions of dollars of home equity in the U.S. right now. And we're doing probably close to $1 billion of volume this year. Our competitors are, doing not quite as much, but similar volume. So let's say the entire industry is doing $2 billion or $2.5 billion. Even if you just look at the HELOC market, I want to say it's a $50 billion a market, $50 billion a year market of folks accessing that capital. So we've only just scratched the surface. And as we continue to iterate on this product and create, different variations for different use cases and different alternatives and hybrid products that address, more nuanced use cases along the spectrum, the upside is enormous. And we don't have to really take much of that, if any of that, HELOC volume or home equity loan volume to build a gigantic business. But I think, because I think, again, 50 billion of volume on a base that's in the tens of trillions is there's so much upside and so much opportunity out there. So I think that is definitely a focus. And the other thing I'll say is, we operate in a bunch of different states. there's a focus on ensuring that we are getting regulatory clarity as we continue to move forward. There's 50 different state regulators, and they all take a slightly different approach to this. We operate in a space that is not currently regulated. We advocate for regulation because we think it will create much more certainty and clarity. But obviously, we want that regulation to be predictable and consistent with the product. So we have proactive conversations with regulators that we work with on an ongoing basis, and different states, of course, different approaches, but we're working on that. That will unlock, we think, a lot more certainty, a lot more clarity, and a much bigger opportunity, especially in cows.
Are there specific consumer protection rules that you believe would most accelerate sort of mainstream adoption of home equity investments?
Question, and I wouldn't want to get too far down that path without having, like, we have a general counsel who spends all his time, a lot of his time, focusing on these questions. So I wouldn't want to. Yeah, it's that. Yeah, I'm a recovering lawyer, so it's a dangerous prospect. But look, yes, I think the answer is yes. We have model legislation that we've rolled out, and we're in the process of trying to get. Again, it's a matter of just clarity. I think the challenge of operating a consumer financial product in an environment where there isn't clarity around how the product should be treated, and we err on the side of overdoing it. Like we err on we operate sort of in voluntary compliance with these things because we think it's important, and we disclose what we think is important and appropriate to the customer. But yeah, I wouldn't want to have that conversation without having Josh on this.
Okay. I saw where you had commented on Housing Wire that conflicting macro signals are likely to keep the Fed patient on rates. I'm wondering if how does that view shape your near-term mindset? What do you think?
It's a great question. I think, look, we're in a fairly volatile environment, and capital is of critical importance for the business. And so I think we need to be thoughtful. We need to be mindful of what's going on. We have long-term relationships with our capital providers, and we feel good about where things stand, but we obviously have to be aware of what's going on. And there's a little bit of a push-pull, right? I think on the capital side of the equation, volatility in the rate environment creates a little bit heightened uncertainty as to where that's going to shake out. On the homeowner side of the equation, rates going higher actually generally tends to help demand because there's less available access for mortgage financing. So like it's not quite linear when you think about how we operate in the environment, but generally speaking, like we can't operate without capital, and so we've got to stay very close to that market. And so yeah, look, we're always paying a lot of attention to what's going on in the capital markets, and in an environment like we're in now, we've got to pay even more attention to what's going on and stay closer to it because things change weekly, daily, hour.
We want to quickly touch on AI with you, and we're wondering if you can give us some insight into the company's strategy for adopting and integrating AI technologies into its operations. How's that being done?
Look, I think it's a great question. It is, and again, not my area of expertise per se. We're always keeping an eye on it. We're exploring, and I think the challenge is like it's come so far so quickly that frankly we're still scratching the surface on what the capabilities are. I think there are some obvious sort of efficiency applications for customer facing Q&A or FAQs where it's like, hey, if you look at our inbound questions from consumers, especially folks that are pretty early in the funnel, they fall into like one of 5 or 6 buckets, and they're pretty straightforward, pretty easy questions that you can address with AI and automation. the other thing we want to be careful of, because, we think it's very important to our brand and to our value proposition, is like, look, we place a lot of value on the homeowner experience, and we've established ourselves as a brand based on trust, and a brand that puts consumers first and has a very, very high ratings when you look at, Trustpilot and Google and all the things that matter. And so we want to utilize AI to the extent that it can create a better homeowner experience, but we don't want to try to replace that interaction, that human interaction that we think is so important to our homeowner experience. So it's a balance. And I think there are opportunities to do some more really impactful things in the operations of the business that are internally facing or are investor facing, that would allow us to create a ton of leverage. So we don't I wouldn't say we have a necessarily defined strategy per se, but we are certainly evaluating opportunities to insert it into the process and test it when it makes sense.
When you think of your finance organization, I'm wondering, as a prop tech company, does your finance organization operate a little differently? Is there something distinct about it? Maybe it's where you place the talent, or where you where you invest in talent. But as you compare notes with other finance leaders or consider other industries, what sets your finance organization apart?
I think, again, if you think broadly from at a macro level, sort of the 30,000 foot view, like, because capital is so sort of mission critical to our business, and in other businesses, it's frankly not a consideration at all. I mean, you think about a SaaS business, like, they don't have anybody in capital markets, let alone, 8 or 10 people that are focused entirely on capital markets. So, it's a vastly, like, the complexion of the organization looks very, very different because there's such an huge, importance placed on the capital component of it. I think the other pieces of it, I would say, the accounting, the accounting team, we manage some GPLP funds. And so we do have a slightly different complexion to the accounting org than you might otherwise, because we've got an investor relations component that's sort of built into fund management. Similarly, with respect to capital operations, the strategic finance FP&A function looks, I would say, broadly similar to what you would see at another org of our size and scale. And again, depending on your overall strategy, so companies that are, and we are not this company, but companies that are engaged in more of a roll up strategy or are have a higher velocity of new product development, their FP&A and strategic finance function is going to look different, because you're going to have more of a corporate development. You're going to have a different lens on, how you're thinking about opco financing. So there are, maybe more subtle or nuanced tweaks here and there, but I would say, broadly speaking, the biggest difference between us and the sort of the non-capital businesses is that capital markets component. And it's a different skill set. It's a more specialized skill set. It does require broadening out your search profile. So,
Is it require a different culture of some kind? Is there,
yeah, that's a good question. I think you want to be, you don't want the tail to wag the dog. So I think you really need to maintain, the finance org. The finance org is not even, I don't think we're even 10% of the overall company. If you look at us in terms of headcount, and the capital function is a subset of finance. So to suggest that the capital team should be either have its own culture or set the culture of the company, I think would be inappropriate. But it does mean that, like, the communication and the culture have to adapt to reflect, I think the challenge that you face, and again, Hometap has been doing this a lot longer than I've been here, so I wouldn't say that this is a challenge I faced at Hometap, but we definitely had to wrestle with this a little bit at Divvy, is, you really have two customer bases. You've got your homeowner customers and your investor customers, and they are both equally important. and you have to balance that. And so again, in the context of a software company, for example, has one set of customers. They have their software buyers, and that's it. If you have a manufacturing business, you've got to manage your supply chain, and those are, you're still a customer, but it's also an important relationship. But, we have to sell a product to the homeowner, and then we have to turn around and sell the same product to an investor. And if it's too out of whack in either direction, it doesn't work. So if we design something in the lab that's perfect for the investor, and then we can't sell it to the homeowner, well, then we don't have any product to sell in either direction, and vice versa. So this balance has to really exist throughout the entirety of the organization. So from a cultural perspective, you do need folks that can code switch, for lack of a better term, and understand the balance and not skew too far in either direction. Like you want your sales function, your customer facing, your homeowner facing org to prioritize those customer relationships, but they have to do it in a way that's also reflective of the fact that we have to then turn around and there has to be some juice left in the orange for the investor, and the investor relations folks have to have the same conversation. Like, hey, if we do this for you, then we can't sell it to the homeowner because it's 2-0 sum. So there always has to be this balance. And again, going back to the banking, the conversations we had earlier about how does the banking relationship or banking experience relate? I think again, you're broker dealer as a banker. You're not actually taking the risk in always. You're matchmaking. You're working with the company to design something that works for their needs, but you're also working with the investor to find something that works for their needs. And you're trying to find the area where it matches up. And, hopefully you're able to do it more often than not, because if you don't find a match. So. What I would call my most formative experience, financially, but also career professionally, was the great financial crisis of 2008, 2009. And again, I was at Lehman Brothers. The entire business shut down. I had to carry my stuff out in a box. And we didn't know if we had jobs. It was chaotic. It was sort of carnage. And so, but what I remember distinctly from that period of time, and it was really impactful as a former lawyer, is at the end of the day, the relationships are what matter. What's written on the page, what's written in a contract, and you'll spend hours, weeks negotiating and paying lawyers to negotiate the perfect document. And then at the end of the day, the relationship is what's going to drive it. It doesn't matter what it says in the contract. And if I don't trust you, then I'm not going to give you the money. And if you don't trust me, you're not going to do the deal. And it doesn't matter what's on the page. And so I went through it as a relatively, young banker, but I took that lesson away. And then when we got to 2020 and we ended up in an unbelievably chaotic environment, and really nobody had there was no script. There was no sense as to what was going to come next. And we didn't know if delinquencies were going to spike, if we didn't know if customers were going to pay their rent. We had absolutely no idea what was going to happen. But what we did know was that we had relationships with our banks that were of critical importance, because without them, the business would shut down. We needed their help, and we needed them to trust us. And so we engaged in a series. We were very proactive. We spoke with our banking partners. At the time, we had 2 different banks that we were working with. We gave them all the data that we had. We told them what we thought might happen. We worked with them to get relief on covenants and relief on reporting requirements. And I remember distinctly having a conversation with one of our bankers who said, I said, look, I don't know what else. I was apologetic, because I was like, look, I don't know. I really don't know what's going to happen, and we're doing our best. And he was like, no, look, we appreciate it. He's like, you don't understand. You guys, we have other companies where the CEO won't pick up the phone and they're hiding. And that's not, I was like, I don't understand how you could do that. He's like, yeah, but they don't know what to do. They don't know what the answer is. So they just don't answer the phone. And I'm like, but cutting off your nose to spite your face, right? Because it's at the end of the day, I have the money and I won't give it to you if you don't pick up the phone, but they don't know what the answer is, and they don't know how to have a conversation, and they don't want to be transparent because the whole thing's been kind of built on a house of cards, and they've sold us a story that now is no longer true, and they don't want to. So again, it just came back to this, like, the power of the relationship, and the words on the page are important, and you need to spend time and understand what they mean, and you need to negotiate a document that makes sense for the company and that covers the risk, and and the bank's going to do the same thing, the investor's going to do the same thing. But fundamentally, at the end of the day, like, it really is a relationship, and the relationship has to be built on trust. And I sort of always implicitly had that expectation and that assumption. And again, it probably was pretty heavily informed by my experience during the financial crisis. But the immediate impact, and by the way, I guess the punchline is the banks were like, yeah, this makes sense. We understand. We had a couple of conversations about whether did we need this or did we need that. And it was a pretty easy conversation. We got the covenant relief we needed. And frankly, we actually didn't even need it because things came back much more quickly than we were anticipating. But that transparency, that relationship, that trust made the conversation like pretty easy at the end of the day. Because again, the banks didn't want to own the company. They didn't want to end up holding the bag either. And so they were just like, look, help us help you. And the way you do that is by sharing information and by ensuring that, there's a relationship built on trust. And that's really, at the end of the day, like, it drives all of it. And, reminding people and making sure people see the forest for the trees and ensuring that people are focused on what really matters. Because again, look, the documents are important, and you can't just you can't do everything on a handshake and, a couple of things jotted down on a napkin. Like, it has to, you do have to protect yourself and the company, of course, but fundamentally it all is all about the relationship and relationship management, and transparency and trust go just so far. And it really advised me.
Before we go, we always like to ask our guests to reflect a little on the personal side with us, Tom. Is there something, you've only been there 6 months or so, but is there something many of your colleagues might not know about you, something from your past? Maybe it's an interest that you have, sport that you participated in, don't know. Anything come to mind?
The only thing I can think of, you can probably see over my shoulder is a bunch of European soccer or football, European football scarves there. That one's pretty obvious because it sort of shows up in the background of every one of these phone calls. And so don't get too far without that. So having lived in London for a long time, my son and I, whole family really, but my son and I are pretty diehard football fans. I would say the one thing that people probably don't know and maybe don't guess is that I'm a pretty huge Deadhead. Went to a bunch of shows back when Jerry Garcia was still alive. Never actually toured with them, but I got close, and I spent, most of my high school trading tapes and frankly most of college as well. And so, I still listen pretty avidly to music that at this point is 40 or 50 years old, and I find new stuff in it every time I listen. But that's probably something that people don't know. Yes.
We are up to our final question then. And this is where we ask you to look forward. And what we want to know are your priorities for the coming 12 months. What would those be?
So, I've been here for 6 or so months at this point. I've gotten my arms around the organization. There's been some change in terms of how we think about just organizational. So my focus really is ensuring that, we can navigate this, pretty uncertain capital environment over the course of the next 12 months and ensure that we've got enough capital to run the business the way we want to. Try to streamline and move towards standardization on a lot of these things. So Hometap's at an inflection point where we've transitioned out of what I would call the very early stage, and we're now in a growth stage. And in order to do that and do that effectively, we have to start to, herd the cats, for lack of a better term, and move to more standardized terms and more standardized scalable processes. So I think we're in that transition phase where we've got some legacy relationships and legacy facilities that we need to think about rationalizing, maybe the wrong word, but starting to move towards a standard. Because I really feel like that is going to be pretty critical for us to start to really scale this business and scale it efficiently and effectively. And then the last thing I'll say is we are, as going back to my prior point around platform, I want to spend time with with the executive team, but also with the product team, and think through like what are the next steps around product development, and creating it, moving towards this platform. And frankly, part of that is also brand marketing and thinking through like how do we start to separate the brand from the product to ensure that when people think of Hometap, they think of it great HEI experience, but they also think of Hometap is going to help me figure out my home ownership challenges as opposed to just like one very specific niche product. So I think that's where we're focused on over the course of the next month. At the end of the day, like we can't do any of it without capital. So that is definitely the focus. That's sort of the first among those focuses. But yeah, think about all those things.
Tom Egan, thank you for joining us on CFO Thought Leader.
Thanks, Zach.